Bitcoin maintains strong support near $117,800 amid heightened institutional demand and cautious trading behavior among whales and liquidity providers. Derivative markets showed modest declines in open interest, indicating reduced leveraged exposure. Meanwhile, spot ETF inflows continued to underpin price floors across token markets. Institutional stakeholders reinforced accumulation strategies at current levels to hedge against systemic volatility. Market sentiment shifted toward controlled optimism as major holders signaled long-term confidence. Ethereum demonstrated similar resilience, consolidating between $3,770 and $3,820 as ETF subscription flows increased slightly today. On-chain metrics revealed elevated staking activity and growth in decentralized finance usage across major protocols. Retail interest in Layer 2 scaling solutions, such as Optimism, surged, suggesting broadening ecosystem participation. Meanwhile, volatility remained contained, with realized volatility metrics holding near multi-week lows. Traders interpreted this as structural strength masked by short-term noise. On-chain whale maps highlighted a significant transfer of approximately $150 million worth of Doge tokens from custodial addresses to exchange wallets, signaling potential short selling or strategic trading. Doge price remained range-bound between $0.224 and $0.228 despite elevated speculative flows. Analysts track median wallet accumulation as behavioral anchors at major breakout levels. This activity illustrated diverging capital flows within meme asset segments. The broader implication flags selective capital focus on liquid meme tokens even during retracements. Small-cap cryptocurrencies such as Bonk and SHIB experienced pronounced volatility, with prices declining between 5 and 9% amid liquidity rotation and rising profit-taking. Lower market depth and thinner order books exacerbated the sell-off when markets weakened. Institutional players largely abstained, focusing on BTC, ETH, and XRP exposure. Sentiment indicators across these tokens turned sharply bearish. This divergence reinforced the bifurcation between retail-driven small caps and blue-chip digital assets. XRP outperformed most altcoins, rallying around 3.8% as trading volumes spiked across regulated exchanges. Liquid exchange flows pointed to strong demand for XRP in derivatives markets, particularly around futures contracts. Positive regulatory resonance regarding U.S. infrastructure reforms bolstered investor sentiment. Analysts speculate that renewed compliance clarity is drawing capital into XRP's liquidity hubs. Technical models now indicate XRP resistance levels near $0.62 for possible breakout continuation. Crypto liquidations escalated with approximately $325 million in long positions liquidated across major tokens during a sharp 90-minute sell-off window. Ethereum led with $185 million in liquidations, followed by Bitcoin at $110 million, underscoring vulnerability in leveraged riders. Funding rates surged upward during this time frame, contributing to rapid margin calls and capital evacuation. After the spike, realized volatility stabilized quickly, reflecting capital readjustment rather than panic liquidation. Risk managers interpret such events as critical signals for adjusting leverage thresholds. Bitcoin ETF flows reversed into net outflows of around $47 million, the first daily negative net after 4 successive inflow sessions. Fidelity and other large issuers reported modest redemptions, indicating tightening institutional risk allocation. Ethereum ETF flows also cooled, with modest net inflows of just $6 million. Analysts suggest these reversals reflect rebalancing rather than outright bearish sentiment. ETF dynamics now show increased sensitivity to daily price swings at institutional scale. Equity markets responded to rising trade tensions following new tariff negotiations between the US and Canada regarding auto imports. The S&P 500 declined approximately 1.1%, while Nasdaq dropped 1.3%. Technology and consumer discretionary sectors led losses, and safe haven flows into utilities and healthcare supported relative stability. Corporate earnings announcements from major tech firms later this week could recalibrate sentiment depending on outcomes.
capital rotations lean toward recession-resistant sectors amid trade risk escalation.
U.S. employment data remains steady, although real wages showed mild deceleration, reducing confidence in stronger growth implications. Consumer sentiment indexes dipped slightly, hinting at cautious households approaching late summer. The Federal Reserve's recent commentary emphasized persistence of core inflation near 2.5%, alphabetically moderating rate cut optimism. Bond yields declined modestly as traders priced in continued caution. Cross-asset correlations weakened as investors recalibrated capital flows based on macro uncertainty. Commodities showed mixed movement. Gold prices rose 9% on safe haven demand, reaching near $3,390 per ounce due to crypto pressure and inflation uncertainty. Copper fell sharply by 3.1% amid trade concerns and industrial slowdowns. Oil futures remained range-bound near $85 as OPEC signals reaffirmed production discipline. Energy equities maintained narrow gains. Commodity ETF inflows remained selective and tactically aligned with macro indicators. Bond markets remained composed with Treasury auctions clearing smoothly and credit spreads relatively stable. The 10-year yield hovered near 4.15%, while 2-year yields held near 3.95%. Real yields rose slightly amid inflation resilience, cushioning bond investor activity. Mortgage-backed securities remained resilient, but lending activity slightly decelerated due to rising financing costs. Fixed income portfolios shifted marginally in response to interest rate progression. Bitcoin dominance held above 60%, signaling renewed investor preference for major assets as altcoins underperformed. On-chain distribution patterns pointed to increased long-term BTC accumulation by foundational institutional holders. Market depth facilitated modest price decline absorption, especially during brief sell pressure episodes. Analysts note strengthened on-chain fundamentals as long-term capital flows anchor valuation floors. This structural shift reduces systemic liquidations risk across crypto capital allocation strategies.
US-listed Roku and Coinbase tech equity pair traded in correlation, with Roku shedding nearly 2.5% after Coinbase's Q2 journey announcement. Both equities reflect retail engagement risk and digital asset platform narratives. Meanwhile, Robinhood shares rose approximately 1.2%, driven by stronger-than-expected crypto transaction volumes. Analysts noted investor rotation between platform equities based on revenue outlook and crypto usage trends. Capital flows highlight digital finance equity as core adjacent market. Stablecoin reserves remain steady, and USDC and USDT usage across treasuries increased marginally amid ETF outflows. Regulatory clarity around new federal stablecoin frameworks helped maintain institutional comfort in cash-on-chain positioning. Liquidity usage metrics demonstrated comfortable reserves with safe haven adoption for treasury operations. Banks started experimenting internally with tokenized fiat as settlement rails, further embedding stablecoin utility. Analysts expect this trend to deepen regardless of market direction. Venture capital witnessed renewed interest in crypto infrastructure, while early-stage speculative dApp funding remains subdued amid volatility. Projects in custody, token settlement, compliance tooling, and interoperability attracted funding attention. Startups with proven revenue models and regulatory alignment continued to attract investor interest. Capital flows became more selective, prioritizing structural utility over hype. This reflects maturation in digital asset capital deployment channels. NFT collectibles saw mixed reactions, with blue-chip pieces stabilizing at nominal profit levels, while community-based assets contracted by approximately 4%. CryptoPunk's floor price held above $210,000, while trading volume on curated collections normalized. Investors now emphasize lending-backed NFT strategies and fractional ownership models. The decoupling between mainstream protocols and niche assets underscores segmentation. Analysts interpret current trends as realignment rather than speculative retracement.
Derivative instruments usage showed demand for protection trades. Collar and straddle positions gradually increased in volume as implied volatility rose moderately. Crypto options open interest sustained above $75 billion collectively across tokens, albeit with reduced directional gamma exposure.
Funding rate spreads compressed slightly after margin market moves. This reflects growing maturity in institutional configuration of hedged strategies. Market adaptation continues even with relational volatility shifts. Market sentiment indicators teetered toward elevated concern levels, but not outright panic. Fear and greed index fell into cautious sentiment territory at around 46, indicating neutral to negative bias. Equity futures recovered late session losses, partially following corporate update optimism. Volatility skew remains moderately high, indicating price sensitivity to macro triggers. Risk appetite oscillates in confined bands amid data ambiguity. Inflation trajectory uncertainties linger, with energy prices stable and core services inflation showing slight upward drift. Fed watchers now expect rate cuts possibly delayed until late Q4 or Q1 next year. Economic growth signals remain tepid across consumer and industrial indicators. Market participants forecast conditional easing tied to sustained softness. This backdrop increases market risk premium and informs capital allocation models. In summary, today's market environment reflects a confluence of short-term liquidation pressures, policy recalibration, capital rotation toward high liquidity assets, and strategic accumulation by institutional stakeholders. Bitcoin and Ethereum anchor capital flow stability, while altcoin volatility intensifies risk segmentation. ETF dynamics indicate sensitive institutional preference shifts tied to macro triggers. Trade uncertainty and inflation data continue to shape equity direction. Strategic positioning now demands disciplined hedging, regulatory alignment, and structural asset focus.